Welcome to Dukascopy TV. I'm Elaine Stenson. For the second time in 2 years, Standard & Poor's recently downgraded France's creditworthiness, with the country having lost its top rating earlier in 2013. The agency's report said it was unlikely that France's reforms so far would result in a mid-term stabilisation of the domestic economy. Meanwhile, last month, S&P Dow Jones has cut Greece from developed market to emerging market status. The move will mean S&P's range of equity indices, which are used as benchmarks by active and passive funds, will be rebalanced to reflect the reclassification in September 2014. Today, I'm going to look at the next country that's at risk of being downgraded. I'm joined on the line now by Remi Bourgeot, Head of Economic Research at the asset management company Financiere de la Cite in Paris. Remi, we've seen the recent downgrades of Greece and France, but over the next few months, what country do you think is next in line for a downgrade?
Well, to answer this, we should wonder whether there still are big vulnerabilities that could derail the current crisis management strategy in specific countries, which would make downgrades very likely in this case. Well, first of all, the strategy relies on hopes of a strong economic recovery through exports in so-called peripheral countries. Well, there's a strong export dynamic in Spain and Portugal, indeed, but the genuine recovery is still really not there. The uptick in growth has proved very fragile, if not short-lived in some cases, and the credit dynamic is still extremely weak. And as a result of this, debt ratios are still increasing tremendously with no stabilization in sight. And mass unemployment is really weighing, especially in Spain. And the deflationary pressures are weighing too on debt dynamics. So peripheral countries are still really a source for concern in this regard. On top of that, the situation in the banking sector is still a big worry for most of these countries. The increased deadly embrace between banks and the sovereign is an issue as well. In the absence of a genuine banking union, recapitalization needs on the part of banks might end up putting government finances even more at risk. Besides, corporate debt is still a big issue that puts banks under even greater pressure in these countries. Stress tests next year could be very revealing on this front. The recession has led to a huge surge in corporate debt in these countries. For instance, almost 40% of non-financial corporations' debt in Spain is owed by companies with interest coverage ratios below 1. And that means those companies' annual revenue is not enough to simply service their debts. And this number is above 40% in Portugal and around 30% in Italy. Well, this means banks' balance sheets and the sovereign are still very much under pressure, with widespread debt overhang remaining and even getting worse through these economies. Well, these issues point to likely adjustments on debts, both public and private, in the end. We might think of soft restructurings in the first place. Ireland provided an example of that sort of action when it restructured its promissory notes overnight into regular bonds, long-term bonds. From a general perspective, European expertise has improved a lot on the debt restructuring front since the fiasco in Greece, typically. But there's still such widespread denial, even in the face of skyrocketing debt ratios, and that is a result of the crisis, of course. While these adjustments could mean further downgrades at some point in peripheral countries, of course. Well, even though they are already quite low currently, but still above junk status, and I think especially of Spain in this case.
So Remi, you think Spain is most at risk of a downgrade, but what are the actual effects and the consequences of these downgrades? What do they actually mean for market sentiment in terms of each country?
Well, in the case of France, very recently we saw that the downgrade had barely had any impact in terms of market impact. And more generally, sovereign ratings can be relevant to international capital markets. But what has actually happened in the Eurozone is that public debt has largely been renationalized. This means public debt is largely in the hands of local investors who pay far less attention to rating agencies. More generally, crisis countries have balanced their trade and current accounts very fast, notably through the collapse in domestic demand. And an important consequence of this is that these economies at large now rely far less on international investors, and as a consequence on rating agencies' assessments. Beyond very successful communication tricks like the OMT program, for example, this balancing in current accounts is really the main reason behind the relief in peripheral bond markets. Due to depressed demand in crisis countries, this is really a feature of the Eurozone picture that will last and eventually matters really more than rating agencies' assessments.
What's the main criteria that downgraders like S&P or Moody's look at when they're making a decision? What would be the main factor in terms of economic stability?
Well, they're still very much focused on public accounts and the growth outlook. But the current crisis has to do with far larger issues actually. And external deficits and that kind of things is something that they pay less attention to, and that's a problem with their assessment, even if it's broadly coherent with the tools they're using. But given the evolutions I was mentioning regarding those countries' reliance on international markets, these tools are not always the most relevant right now for assessing those countries. I don't think we are going to see significant downgrades anytime soon. There might be some sort of technical adjustments because you have always some discrepancies between the big three rating agencies. That could happen, but that is not extremely significant, of course. But in the short term, I don't expect any significant downgrade because the main adjustments I was mentioning on debt will happen quite later, I think.
Okay, Remi, thank you very much for joining me on the line today. And that's all from me for now, but do check back for more interviews and updates from the TV team. Bye for now.